Thanks for joining. I'll try that again. Hello, everybody. Thanks for joining. This is the June 2025 real estate market update here with one of our frequent and favorite guests, Steve Davis of Total Wealth Academy. Hello, Steve.
Hey, how you doing, Jeff?
Good. So Wade is not here. Wade is going to miss this one today, so it's me and Steve. But we'll get after it and we'll go ahead and get started. Do you mind going to the next slide, David? One more. So Steve, for those of you that don't know about Steve and Total Wealth, Steve has been in real estate business for the last 30 years. We have a great relationship with Total Wealth. They do an outstanding job of teaching people how to really change their life in real estate. But it's not all about real estate at Total Wealth. They talk about other aspects of enriching your life. So Steve, before I butcher your commercial, and go ahead and tell the folks about Total Wealth.
Sure. Total Wealth Academy is a mentoring program for beginner and advanced real estate investors. And what we focus on is buying income producing real estate, whether it's groups of single family houses or big 2, 3, 4, 500 unit apartment complexes, self-storage complexes, senior living complexes, strip shopping centers, anything that produces cash flow. We exist because 95% of Americans fail to retire by age 65. So what our members are doing is building a second stream of income so that they can retire at any age, and that second stream of income lasts them throughout the rest of their lives. So we are a hands-on mentoring program. All of our programs include mentoring, where we literally walk you step by step through your deals until you know what you're doing. And we recently had a deal night, and Jeff was there. I got to brag about Jeff a little bit, and Total Wealth Academy, but we had the Total Wealth Academy deal night. I think there were 11 zero down deals thanks to your financing, right, Jeff?
Yeah. So like Steve is correct. We sold, I think we sold maybe 9 or 10 properties that night, almost batted 1,000 basically.
Yeah.
And we have a partnership with the Seago Group, and they do a great job of finding single family properties. There's a few multifamily sprinkled in there as well, but they do a great job of finding single family properties. And although I would love to take a lot of credit, and I appreciate that, Steve, we do offer no LTC. So if you find a great deal, like a lot of these deals were a deal night, where you can buy it and rehab it for under 75%, we can finance the whole thing, and oftentimes plus closing costs. So there were a lot of people walking out of that building with a lot of smiles on their faces, because, like to your point, they were able to pick up real estate and do it with really no money down. Now, that doesn't mean you have to have some money to qualify and do deals. I'm not saying you can just do this stuff with no money in the bank, but as far as the deals go for investors, we're seeing a lot of great deals come out of deal night at Total Wealth.
Yeah, I couldn't believe that sixplex was zero down. That was crazy.
Yeah, no, it's there are a lot of strong deals. So if you're not a member of Total Wealth, get with Steve and his team. I highly recommend you check them out. They do a great job. If you are a member, and you haven't been to a deal night, be on the lookout for the next one. I'm sure we're going to do one next month as well.
Yes.
So show up, make sure you're pre-approved. That is one of the requirements. You have to be a Total Wealth member, and you have to be pre-approved to actually buy. But you have plenty of time to do that between now and then. Check it out, and you can either start your career with finding some great deals, or you can keep it going and add more to your portfolio with some outstanding deals. And like Steve said, there's some small multifamilies as well. So we're very pumped. Great night, great turnout. I think a lot of people signed up as well in Houston and Dallas. So all good things.
Yeah, it was exciting. Yeah, anybody that wants to find out about Total Wealth Academy can go to totalwealthacademy.com. and we offer a hour and a half free sample class live in Houston, live in Dallas, or online if you're outside of one of those areas. TotalWealthAcademy.com, click on the free sample class and check that out.
I was going to ask you about that because you guys have locations and you have offices in Houston and Dallas, but there are, like you said, there are people that sign up for Total Wealth that live all over the country.
All over the
Honestly,
country.
yeah. So I don't know if you can speak to that with regards to people that buy properties, maybe not in their backyard, maybe not even in their home state, but they're able to invest in real estate. Do you see a lot of that?
Yeah, I see a lot of people from California, a lot of people from New York. They want to buy in Texas because they can't get any positive cash flow in those states. The prices are just too high.
Yeah.
So, yeah, we have a lot of people who do third-party management and they're investing in Texas. So it doesn't matter where you're at. I will suggest this though, search your area first. I prefer my students to own their real estate within about 30 minutes. But if, like in California or New York, you just can't find them, then we'll help you find them in Texas.
Sounds good. Well, that's all right. Let's go to the next slide. I'll read I'm going to read the disclaimer. Go back. There we go. So just for the folks, this presentation is for general information only. No information, documents, or estimations presented here represent any final determination or investment performance. Catalyst and or its agents, guest speakers like Steve and representatives cannot and do not guarantee any rate of return or investment profitability based on the information presented. By attending, you acknowledge and agree Catalyst and or its agents do not assume and hereby disclaim any liability to any party for loss or damage caused by the use of the information contained here. All right. I need to work on my speed reading skills, but I'll try to do better next time. And then briefly for folks that maybe are new to Catalyst and or maybe they've just never heard of Catalyst and this is their first time, as a reminder, we are a one-stop shop for real estate investing lending. So if you're a real estate investor, we're able to handle the hard money loan up front to acquire the property. And then if you're doing a buy and hold, we're able to handle the long-term refinance as well, whether that be a conventional loan or whether that be a DSCR loan, either one. All of our loan officers are fully licensed. So if you like your loan officer that does your hard money loan, great news, they can handle your refinance as well. Let's see, 5-star customer experience. For all the great things I could say about Catalyst that I believe, you can go check out our Google reviews. I think we're at a 4.9 right now with hundreds of reviews. Let's see. Yeah, the last thing I would talk about is maybe our bridge program. We have a for investors that do buy and holds, and then we'll move on to the data. We have what's called a bridge appraisal program that's designed where the same appraiser will do both the hard money and the long-term appraisal. And typically, as long as the rehab is handled quickly within, say, 90 to 100 days, they typically don't rerun new comps. So it's not a guarantee, but it's a very likely occurrence that if you buy a hard money property on the bridge and you get through the rehab quickly and refinance with us, the same appraiser will do the deal and probably come through at the same value. So for buy and hold investors, that reduces the stress of the refi appraisal coming in back lower, right? So you have less money out of pocket or no money out of pocket on the refi. All right. Let's dig into it. So Houston, I'm going to cover the numbers here briefly, and then Steve, if you want to give some insight into what you see, this is your home base, right? You are based out of Houston. So total sales are up 7%. Active listings are way up 29%. So there's a few more sales and a lot more listings. The average sales price is actually down a little bit, 1% year over year. If you compare, we always keep pre-COVID numbers over there to kind of show the long-term effect on these real estate investments. So if you bought a property in May of 2019, The average price was 323, and now it's worth 438, which is a 36% return. Months of inventory, 5.2. So it is up significantly over last year. It's up a month. Pending sales are high. The days on market are pretty flat, right? That's the
Yeah.
interesting part to me. So you see the, I was going to ask you about that, Steve, what you thought. The days on market are roughly the same, but the inventory is significantly higher. So there's more activity. It seems like a bigger market, but houses are lasting about the same as a seller.
Yeah, that's still good
Yeah,
for MLS listing. If you can unload that thing in under 2 months, if you're a flipper, that's a really good sign. I like that number.
yeah, yeah. So I see the the number of listings, and we'll get to other markets later, but when I see the number of listings going up, I see that as you're probably going to have, you're going to start to see a lot more sellers. I don't want to say desperate, but willing to negotiate.
Yeah.
Um, the number of deals that are going to be bought at list is probably going to be significantly lower. There was in the heyday, you'd list a property and you would get over ask quite frequently. You would certainly get ask. These days, sellers they don't have the leverage that they once did. So there's a lot of room to negotiate. So
Yeah.
especially when you're looking at some of these distressed properties. Average leasing, it's pretty flat. The lease price is flat. If you look over a 6-year period, looks like the rents have gone up roughly $500 a month, maybe a little bit shy, maybe 450, I guess, 475. So I was talking to somebody, or we were talking to the class last night about low cash flow deals, and right now with rates where they are, it's tough to find great cash flow deals. You can find some okay cash flow deals, but if you look at this historically, now last year was flat, but over time, typically rates go up. I'm sorry, rents go up, right? So that same property that you bought in 2019 will rent for $500 more a month. Your payment's the same. Now, granted, maybe your taxes and insurance have gone up. That's fair, but I don't think it's gone up $500 a month, right? So
Yeah.
buying deals now, and what we see is a lot more deals where, like Steve mentioned earlier, all those deals with little to no money out of pocket. You're picking up properties with little to no money out of pocket, maybe little cash flow, but in the long run, over time, you're going to see rents rise, right? Eventually, you're going to see rents rise. Your payment's not going to go up. You're locked in on a fixed rate payment. Your rents should outpace taxes and insurance. And then, God forbid, the economy starts going south a little bit. You might see some rates drop, right? And then that's a really big opportunity to pick up some cash flow and lower your payment. Steve, what are your thoughts on this one?
Well, I agree with everything you said. And, you know, to me, when you see it go from 441 to 438, that's no change. So it is flat right now as far as the um, value of the properties. The median for people who don't understand median, half of the houses sold for above 339, half sold for below 339. That's almost the same too. So there's really not much going on. It's pretty flat. What I would like to address is the rentals. And those of you that own rental property, I want you to note something. Look at the days on market. 39 days to lease a house. That means you lost $2,300 in rent, plus however long it takes them to move in. That's just when the lease was signed. Um, do not list your rent properties with a realtor. It is the slowest, most ineffective way to lease property. I'm leasing my single family houses in 7 to 10 days. I'm losing maybe a week's worth of rent, 2 weeks worth of rent. These agents are going to lose you a month or more worth of rent. And they don't care as much as you do. They're not going to care about who's in your unit as much as you will. This goes back to manage your own properties. Manage your own properties. Don't let some real estate agent lease your property.
Um, yeah, that's a great point because if you just do the simple math, think about it. If the market's telling you, the rent should be X, if you just drop it $50, right? If you become more attractive to get that thing leased quickly, $50 for in a year, that's $600. That is significantly less than what you're going to cost yourself if you overprice and you make a mortgage payment or two. God forbid it takes you 2 months to release that property. That's going to eat up all your cash flow, right? Vacancy is the devil when it comes to rentals. So,
Yeah.
um, so figure out your market, make your property a little more attractive for people to want to move in, and avoid those months of vacancy that is just going to crush your cash flow for the year. All right, let's go to Dallas. Again, I'll run through these here, Steve, and then give you a chance to do some analysis. So the sales flat, total active listings, again, like Houston, they're up 24%. Houston was 29. Prices, Dallas is finally starting to come down a little bit. The average price is down 3%. Median price is down 4%. Again, if you look over the longer period, 6 years, you're talking plus 57 and plus 45%. So you bought a house 6 years ago. You bought a house 6 years ago, even looking at the median, because, let's be real. We, as investors, you're swimming more in the median pool than the average pool, right? The average pool is for folks that are those are owner occupants. So median is probably more relevant. But even in a median, you buy it 6 years ago for $275, you're up $125,000 without doing anything, right? Just rent that sucker out. Months of inventory at 4.5, again, up a month, slightly lower than Houston. Pending sales 7,900, days on market 54, which is up 11, quite a bit. But then, like you said, it's not the end of the world, especially when you get to, say, like I said, much larger days on market. I always, and I tend to look at sales versus listings as an interesting stat to me, because you look in 2019, you have 11,000 sales out of 26,000 listings. And then now we're down to 8,600 sales over 29,000 listings. So you have roughly 3,000 less sales with more listings. So again, that tells me as a buyer, you have more leverage.
Yeah.
So
that's good. That's good, Jeff. I didn't even notice that.
Yeah, it's a lot. I just look at the numbers, right? Buyers and sellers. You got 8,600 buyers and 29,000 sellers. That is significantly different than when it was 6 years ago. Anything else to add on this one, Steve?
Well, I'm going to beat it to death, but look at the rentals. The days on market, even in Dallas, 39. That's taking $2,700 plus you're paying the agent, and they're probably not moving in immediately. So you're probably losing 2 months plus what you paid the agent to lease that, when you could have leased it in 10 days if you'd have leased it yourself. When it comes to the prices of the homes, all I can say, Jeff, I wish I had bought 10 or 20 of them at 332 in 2019, because they're now worth 522.
Yep. That's the thing. And I hear Wade talk about it all the time. There's a story of regret. Don't get fixated on the little things. When you're buying a deal, let's say for something happens, it's going to cost you an extra $3,000-$4,000 more than you thought. If you're a buy and hold investor and your goal is the long-term play, look at the numbers on a typical deal that you bought 5-6 years ago. We're talking a difference of 125,000, right? Is 3,000 really worth missing out on a property, right? The regret is almost always not that you bought a house. A lot of times it's the houses you did not buy.
That is the truth. That I go back to
Like you just said, right?
2008, 9, and 10. I picked up 20 or 30 houses. I wish I had picked up 90.
Yep.
Every deal that I turned down, I look back and I wish I had bought it.
I don't think it's possible to buy a house in 9, 10, or 11 and not just
Make
be
money.
crushing it right now. No, it's almost
That's
impossible.
exactly right.
But I mean, let's be fair. And that's, that was a point in time when the market was really down, tons of foreclosures and opportunities. Like, it was a great time to buy. And that, that's a fun story. But it's not even about that. Don't try and time the market. If you can space out your buys, right? If you're just pick up a property or two every year, you do that over a long enough time frame. Yeah, some are going to be better deals than other, but at the end of the day, when you're ready to retire or maybe cash out some of these deals, you're going to be better off. I can almost guarantee you every single one of those properties will be a money winner at some point.
Yeah, one of my students used your strategy. She did two a year. She bought two a year, but she started in like 2007. So she bought two a year for the next 15 years. She's got 37 now, and many of those were bought during the recession.
Yep.
So she's got millions of dollars worth of equity and I think $17,000 a month in cash flow. So your strategy works.
Yeah, she's living the dream, right?
Yeah.
Like I said, people get excited and you want to hurry up and buy as many properties as you can, and that's fine too, right? Be aggressive. If you think it's a good time to buy and you have the financial wherewithal to pick up two or three at a time, we've had customers that'll spend a whole year and they'll buy one a month, right? But you don't have to. If you want to do it, great, but you don't have to. Don't feel bad if you're just picking up one or two properties a year. If you do it consistently over time, don't try and get cute and time the market. Just understand that over time, real estate is a win. It doesn't matter when you're buying. Just keep buying a couple of years.
Yeah. And people who try to time the market, they never take action because it's never the right time.
Yep.
I'll
Yep.
tell you, there's a Chinese proverb that I think is appropriate right here. When is the best time to plant a tree? 20 years ago. When is the second best time? Today.
Yep.
Well, it's the same with real estate. When is the best time to buy real estate? 20 years ago. When's the second best time? Today. Do it today.
Yep. Couldn't agree more. All right. So let's go to San Antonio. Picking on San Antonio of late. It hasn't had quite the returns as the other two markets. I'll go run through these, give you a chance to look at them. So total sales are down 3,200. Listings, 16,000 listings, up 20%. So again,
Wow.
look at I look at those, look at the 19, right? 3,000. The sales haven't really changed much at all. 3,000, 3,400, 3,200, but the listings sure have changed. 10,000, 13,000, 16,000. So again, that just tells me if I'm a real estate investor, I've got more leverage. There's going to be a lot more sellers that are just not getting offers that they'd hoped for. And so you have some buying power.
Yeah, I
Average
think
sales.
there's going to be a lot of good deals in San Antonio coming up.
Yep. Average sales price is 378. That's actually up 2%. And over time, it's up 42%. So as much as the recent news in San Antonio has maybe been a little more negative versus the other markets, if you go back to Houston, who was seen as like this nice, steady, stable market over time, Houston is plus 36 over the same time period that San Antonio is plus 42 and 37. So it's still a good buy. Like you said, Steve, you buy them and hold on to them. Months of inventory, 4.7, which is pretty flat. And that's actually less than Houston. Pending sales, 2,600. Days on market, 72. Now, so I do think if you look at 72 versus 50 and 54 in the previous two slides, 72 is a little bit longer. So if you are flipping a property in San Antonio, doesn't mean you can't do it. We have people that flip properties in San Antonio and make good money every day. It just means you need to account for that. So
Yeah.
when you're doing your due diligence, part of it is holding costs. Okay, you're going to need to assume an extra month of holding costs relative to maybe other markets. Um, the other thing about San Antonio, and I don't know if we talked about it lately, but San Antonio has, let me go back. One more thing about flips. Um, the folks that we've seen be successful flipping properties, their properties have like the wow factor. Like
Yeah.
if somebody when when it's more of a buyer's market to flip a property, I think you have to do a little extra than maybe you would in normal times. If it were seller's market, I do think look at the comps and maybe throw in a little something extra. Um, and again, I'm not that's not free. You got to pay for that. So what does that mean? It means your offer has to be right. You have to account for that. Understand, hey, I'm going to spend a little bit more on this rehab because I want to sell it. I don't want to have to sit on this property and have price reductions every other week. I want to spend a little money and get a little pop. That's fine. You can do it. Just you have to negotiate a little bit the price down a little bit harder than maybe you would otherwise. The other thing about San Antonio is the strike team. If you're doing a project inside the city limits of San Antonio, you have to get permits. We won't do a deal
Oh,
for some. We won't do a deal for somebody in San Antonio without permits. Like if it is in San Antonio, you have to pull permits. They have this thing called the strike team. They go around. They have the boots on the ground, but what they also do is they look online, and if they see a listing pop that looks recently rehabbed, they can easily pull up that property. If there's no permits pulled on that property, then you're going to get a visit and you're going to get a red tag. So it's fine. Permits are cheap. It's not a lot of money, but just don't try and get cute and slip one past the goalie and not do permits. You have to get permits in San Antonio. Steve,
yeah.
anything else?
Yeah. Look at I, everything you said's accurate. Um, the only thing that I wanted to build on was your point about flipping. Make sure that you're prepared to sell it for the average sale price, not just the high. I think that's why they stay on the market 72 days is you're very proud of your product. You want to get the maximum out of it. So you leave it at the high sale when if you put it at the average sale, it'd move in 30 days. And then the same goes for your rentals. But look at the days on market for rentals, 59 days. That's 2 months just right there, plus however long it takes them to move in, plus you're paying the agent. It's just ridiculous to use a real estate agent to lease property.
Yeah,
Put it at the average, raise the rent at the end of the year.
yeah, 100%. The one thing that I do see, if you go back real quick, David, the one thing that I do see a lot of newer investors do, if they're maybe working with an agent that he maybe just doesn't understand or whatever the case may be, a lot of times if you're flipping a property that is maybe on the bigger side when it comes to the square footage in the neighborhood, they will take recently flipped properties of smaller houses and simply multiply the price per square foot by the the square footage of your house. So, right, if it's $200 a square foot, and on those are 2,000 square feet houses, well, I'm 2,500 square feet, so I should be able to get 200 square feet, $200 a square foot times that 2,500. That is not how it works. The larger the property, and all things being equal, you got two rehabbed properties, the smaller house is going to get a higher price per square foot. So
Yes.
to Steve's point, look at the high end of the market. I would never assume I'm ever going to go over that. If you're one of the lucky ones that breaks the ceiling, great, good for you. But this is, if you want to be smart and make sure you're giving yourself the best chance for success, don't assume that you're going to bust the market. Look at the top. It's like if that top is rehabbed, I'm not going to go through that. I need to come down from that and make sure that my numbers make sense based on that. All right, Austin. So 3,000 sales in Austin. That's extremely flat over the last 6 years. Looks like the month of May is pretty much always 3,000 sales. Um, Again, the listings, right? The listings have gone from 3 out of 6 to 3 out of 12 to 3 out of 14.5. The sales price is down 2%. That's pretty flat in my book. Not as flat as one, right? Or zero, but
Right.
relatively flat. So you look at the median price, 450 in Austin. The median price in San Antonio is 315. Dallas is 400. So Austin is still the most expensive market for sure. So you're going to have a harder time picking up rental properties in market. A lot of folks that we talk to that do deals there, they do more like a duplex or a fourplex. That's how you're able to get more cash flow in a market like Austin. 5 months of inventory, and then 57 days on market. So a little more normalized. I think San Antonio is probably the outlier where the cars, the days on market for the flips, properties are moving in 57 days in Austin. Steve, anything for Austin?
I like Austin, but I like the outskirts of Austin for investment, the little towns that surround it, um, as opposed to actually in Austin. Um, the rents seem to be a little bit higher, and I'm getting better value for my dollar. In other words, there's a lot of older houses in need of rehab compared to in directly in Austin. So I love the area. I think it's going to be highly profitable in the long run, of course. Um, but again, I prefer the little surrounding communities.
Gotcha. All right, David, there we go. These are some of the slides that we found that we thought might be relevant. So Texas market shifts in spring and summer. So the balance scales between active listings and sales seems to be tipping quickly, kind of like we talked about. As of April, um, Texas experienced a significant increase in housing inventory, with listings reaching 123,000 higher than the state's historical average. That's a
Wow.
lot of property for real estate. Total active listings increased in all Texas markets, with Houston having the most active listings with 58,000 in May. So the 123 above the average, that's the part that stood out to me. That tells me that there's a lot. I mean, Texas is bigger, don't get me wrong. We've had a massive influx of people. So there's more housing, but that just tells me there's going to be a lot more opportunities for buyers and buy and hold investors. Um, you see a house you like, it's been sitting there for a while, make an offer that makes sense for you, right? Doesn't that disregard list? But if you see a property in a neighborhood you like that needs repairs that you think you can make something with, make the offer that makes sense to you. Obviously, you're not going to hit on every single one. You're going to hit on a small percentage, but like that lady said, you only need to find two houses a year, and you can set yourself up for life, right? So you're going to get a lot of rejections, but all it takes is a couple of yeses, and you're going to set yourself up. All right. This is a continuation. Experts suggest the combination of increased inventory and lower prices indicate Texas may be undergoing a housing market correction. This market shift may present opportunities for buyers due to decreased prices, while sellers might need to adjust expectations and strategies in response to the dynamics. So, kind of what we were just talking about.
Yeah.
So this one is a little counterintuitive, but let me see if I can make sense of it. So home prices all-time high, but rising slowly. Now this is nationwide, I believe. Nationwide home prices, while at a record high for this time of the year, are growing at the slowest clip since 2023 because sellers outnumber buyers. Active listings hit a 5-year high in May, while existing home sales hit a 7-month low. So it, I guess prices are still really high, but the shift is happening nationally as well with the number of available properties for buyers. Median home sale price is sitting at a record high. It's notably lower than the median asking price. That's because sellers are open to negotiating in today's cooling housing market. It took 38 days for the typical home to go under contract, the slowest May pace since 2020, and sales were canceled at the highest May rate on record.
Interesting.
Yeah. I'm curious, and back, I don't know if you're still doing it or back in the day, do you have any experience or do you have any students that have experience with just making a bunch of offers and the best way to find a house maybe that is listed for more than you'd like to pay and to try and get that down to where it makes sense for you?
I think the answer is yes, because I've got one member, I made a bet with him. I I told him, I'll give you your membership back if you'll make 100 offers and don't do a deal. This guy went out and just started writing offers on everything. And of course, he ended up with a deal. Um, so yeah, going out there shotgun method does work. Was that what you're asking?
Yeah, just kind of like, yes, basically, if there's any, and obviously not everybody has the time to write 100 offers. Maybe this guy did, good for him. Um, so yeah, you can, I've talked to people that that's their strategy. They just shotgun offers like crazy. I don't know if there's anybody or any tactics to be a little more precise about it. Um, but yeah, I think it's a great way for people to pick up deals because it's all about the buy. That's the thing. It's all about the buy. It's all about what you pay for the house. The ARV. I'm pretty sure anybody can figure that out. I feel like that's something that with with a little education you can do an ARV. Rehab's a little tougher, but at the end of the day, it's what you pay for the house that makes or breaks the deal.
Absolutely. And you can't recover. It's hard to recover from paying too much. So make sure you're running your comps on both the value of the property and the rents.
100%. Okay, so this was kind of new to me. I saw this. I saw a couple little, I don't know, news articles or scrolls or something about Galveston and just what was going on over there, and I never paid much attention to it. But Airbnb and short-term rentals up for sale. Homes for sale on Galveston Island surged to a 42% increase this year, hitting 1,000 listings for the first quarter, which is double the number of listings 2 years ago. Now, this makes sense. In 2024, the county began treating short-term rentals as a business, adding additional taxes. Galveston had almost 5,000 registered short-term homes in 2023, a 78% increase from 2020. Short-term rental investors are leaving the area due to the increased taxes and insurance on short-term rentals. This has increased housing supply to almost 17 months.
Wow.
You been paying attention to this at all, or no?
Say that again.
You been paying attention to this? Were you aware of this?
I was not aware of this. I did know that
Either.
that a friend of mine has some short-term rentals on Galveston Island, and she told me about the county treating them as businesses all of a sudden. Um, Leave it to the government to screw up a great thing.
Yeah.
Um, so this is a catastrophe. 17 months of inventory. That means they're not selling. That's bottom line.
No, no. I mean, could you imagine? Um, it's a great example, like you said, of kind of government unintended consequences, right? They wanted to make a little money on this, and what happens is plummeting. They just the unforeseen consequences are definitely in play on this one.
You're going to see a bunch of those turn into long-term rentals. They're going to quit doing Airbnb and go to long-term rentals.
Yep, yep. We don't do a lot of Airbnb. That's why we're not really focused on that market. That's why this is kind of news to me. But if I were in that market, I'd be pretty upset. All right, next slide. So AI, land, and power. Between 2023 and 2024, Central Texas and Austin, San Antonio experienced a fourfold increase in data center construction, totaling 463 megawatts of potential demand. I don't know what that means, making it the second largest data center market in the United States.
Wow.
The data center boom represents one of the most infrastructure intensive and potentially future-proofed opportunities in real estate, in areas where specialized construction and robust power infrastructure are available. So, I mean, this, I know there's that, I think Seago was talking about that plant up in, I think it was Taylor, Texas, the Samsung plant that's just a monstrosity. It's huge. But the more business and tech jobs and infrastructure that's built in these markets, it tells me there's always going to be there's just going to be more buyers, right? That is, if you're looking to get into real estate, it's going to help grow the economy, grow the population base. This is nothing but a good thing for folks that invest in Central Texas.
Yeah, that's good news, good news, good news.
Yep. Bernie, Texas. I think David threw a few little anecdotal suburbs here. So last reports comparing April year-over-year data from 2023 shows that Bernie's market has increased considerably. Redfin report showed April 2025 sales price jumped 17% higher than 2024. While there is local debate on the data from the report, there's obviously a very significant growing trend in this city. I don't know what that means. There's debate on the report, but needless to say, Bernie is a suburb that seems to be on the rise.
Yeah, I'm sure that local debate is homeowners trying to argue their increases in taxes.
That very well could be it. That makes sense. All right, here's another one. Princeton, Texas, fastest growing city in the United States. It's affordable. Princeton is strategically located 46 miles northeast of Dallas. I will say, when we do most of our deals in Dallas, very few of them are actually in Dallas. They are all in the surrounding area.
Yeah.
A lot of them go north, some of them all the way up to Oklahoma. But these little towns that are popping up all over Dallas and outside of the DFW area are really, really great little markets. So, city showed population growth of 30%. Wow, over 1 year. Median home price list is at 337, which is extremely affordable. Other notable growing cities: Fulshear, which is down here, Salina, and Anna, which I think are both up in the DFW area, if I'm not mistaken. I know Fulshear's like west of Houston, I believe. Houston, San Antonio, and Dallas rounding the top 5 growing metros from 2023.
Yeah, and they're going to continue to grow. The quality of lifestyle in Houston, San Antonio, and Dallas is so high that people who visit relatives, they want to move here. I mean,
yeah,
it's going to continue to grow.
Yep. I mean, it's attractive for businesses, right? Low taxes, relatively inexpensive real estate.
Yep.
Why not? We have room to grow. Okay, Texas suburbs still dominate livability rankings. Suburbs overtake major metros. So, U.S. News and World Report: suburbs like Leander, Pflugerville, and Cedar Park have outperformed major metros like Houston and Austin. These suburbs offer better affordability, safety, education, quality of life, attracting families and remote workers. The trend underscores the migration pattern away from dense urban centers towards more livable suburban environments. I mean, I've been seeing that. I think for a while there, it was the opposite. It was, there was an urban revitalization. Everyone was happy living in the city. I think it was around COVID when that kind of switched, and people started kind of wanting to get out a little bit more. And I think the suburbs are a lot safer than a lot of these markets.
Yeah.
But it seems like it's kind of getting back to the suburbs is a little more desirable than maybe living in the city. Obviously, there's certain parts of the city that are great, but on the whole, it looks like people are starting to move out of the city and more to the suburbs. All right, so I'm gonna let you talk about this one, Steve. This is a little more in your wheelhouse. Multifamily demand stays firm. Multifamily rents posted gains in May of 2025, with the average U.S. rent increased $6 to $17.61. Year-over-year rent growth was 1%. Uncertainty in the economy and financial markets has so far created minimal impact on multifamily fundamentals, which remained healthy in May. Occupancy rates are slipping in some metros due to the heavy supply pipeline, but the drop is slow as demand remains strong in high supply metros. So What do you see in multifamily lately?
You know, like you described, it's all in the buy, it's all in the purchase. And we're staying away from full price properties. The sales pitch is, it's an A type property, it's in perfect condition, it's got nowhere to go but up. BS. I'd rather buy a beat up C class property and make it a B and add value. Um, and because that's no increase, $6 is not an increase. Uh,
Yeah.
they're pretty flat, as you can see from the diagram there. Um,
Yeah.
so the way we're buying these big apartments is the majority of them are distressed either because of condition or because of financing. What I mean by financing is they've got a balloon. It's the end of their loan. They've got to either refinance or sell, and they can't refinance. So they're selling. And we're picking them up at deeply discounted prices. And then we're still able to increase the NOI and add value that way as well. One of the purchases was $7.9 million below its appraised value.
Wow. That's a good deal.
Yep.
That's a heck of a deal. All right. And so, and then here we go. This one is for you as well, Steve. Deal in new construction. It says April housing starts that were seasonally adjusted were updated to 1.36 from 945, while 1.6 percent higher than March's revised number. It's still 1.7 lower than a year ago. And authorized single family building permits in April were adjusted to 1.4, which is 4.7 below March and 3.2 lower than 1 year ago. So if I look at the charts, it looks like completions are declining from, say, oh, I don't know, maybe a year ago, 6 months ago.
Yeah.
Um, Starts are relatively flat. I mean, they're down from 22. They're just kind of piddling around at the same levels, and permits are the same. So, you have any opinions on new construction?
Well, I think they're scared of those statistics we just reviewed when we went over Houston, Dallas, San Antonio, and Austin. The fact that there are more sellers than there are buyers. Well, they're sellers in addition. So yeah, I think they're a little leery and they're going to draw back a little bit, which is fine. And I guess it's the obvious move, but I think these builders are prepared to ramp back up as quickly as possible if they see a change. But if I were them, I would be a little worried about those days on market, long days on market, fewer buyers. That's got to have them a little gun shy.
Yeah. The only thing I will say about new construction is I have seen we've done a handful of deals as rentals. So they're usually extremely cheap. Like the prices are really cheap.
Yeah.
The properties are small, but the cash out of pocket is clearly not zero like the deals we talked about, but the cash out of pocket isn't so much higher than your typical deal. It's just you're dealing with really small numbers, right? Small house, small price, smaller rents, but it's new construction, so you don't have to go through the uncertainties of a rehab. Not the
What
best.
I noticed recently were a lot of incentive, low down payments, free upgrades. Um, and I also noticed a sign that said that they've got houses that you can move in within 30 days. So they've got them on the ground being built in advance of having a buyer. So that puts some pressure on them too.
Yeah. All right, next slide. All right, so U.S. homeownership and vacancy rates. We talk about this, how they are related, right? So when it's easy to buy a house, when everyone can own a home, vacancy rates typically go up, and then the inverse is correct as well. So if I look at that chart, the rental vacancy rate in the top blue, right? It hit its peak right before the great financial crisis, when it was, you had guys that were mowing lawns, stating $20,000 a month and buying 5 properties. It was very easy to buy a house then, so everyone had one, right? But then
Yeah.
as it gets more difficult to buy homes, the rental vacancies drop, right? You have more people that need to rent. Now I've noticed, I'm looking at this chart, I've seen a slight increase recently. And my only, and you can tell me what you think, I'm not sure, but my only guess is that vacancies are going up. I think the shock of the high interest rates is starting to, or higher interest rates is starting to kind of settle in. And people are kind of getting used to what the current market is. So the unaffordability it's dropping a little bit, I think. So you have
Yeah.
more people that are looking to buy houses. I'm just kind of thinking that through as to why there would be this spike recently. I don't know if you have an opinion, but I think it's the normalization of the rates.
Yeah, that could be one explanation. Um, but where they get these statistics, I'd be real curious. I'm assuming it's coming from the National Association of Realtors.
I
So
think
this
I think it's
must,
according. I think it's from the U.S. Census. I think is the
oh,
data up here. Yeah,
oh, I see it now. My camera was in the way. Sorry about that.
yeah, that's okay.
That's interesting, but I still have to ask, where did they get the information? Because the census, um, I guess, I don't remember ever receiving a mail out that said how many houses do you, and how many of them are occupied. Uh,
That's true.
so I think this is just based off of the National Realtors Association. So it doesn't take into consideration the private investor that leases their own properties, because I haven't heard any complaints from any of my members about occupancy going down at all.
Yeah. All right, next slide. Actually, we can skip the next slide because it's pretty much the same chart and then go to the interest rates. The reason why I wanted to show this one briefly, if you look right around, I guess, 2021, 22, when the rates started going up, they've been just kind of bouncing back and forth, say between 6 and 7.5% over the last couple of years. The reason why I wanted to show this is because earlier I said it's starting to, yeah, there you go, 6.8, 6.8. It's it's starting to normalize. The psyche is starting to normalize, but the numbers, this is normal. We were in a period of basically free money for so long. People just they forgot that interest rates could be higher than 3%. But if you look historically, going all the way back to say 1970, right on these charts, it doesn't dip below where we're at really. It does briefly in the late 90s. And again, the early 2000s, it's still higher than where we're at. Like it doesn't start dipping significantly below where our current market is, I would say really until about maybe 2010. So the last 10 years have been the outlier, similar to like say the late 70s, early 80s, where I would call maybe that an outlier on the high side. These last 10 years were an outlier on the low side. I think the period we're in right now is more of a normal number than anything else.
Yeah, and then people also need to keep in mind that these are not high interest rates, these are normal interest rates. And also, marry the house, don't marry the interest rate. If the interest rates drop, you can always refinance and
Correct.
increase your cash flow even further. But you don't want to be sitting on the fence because it's 6.86. Get out there, get these properties done, get them in your portfolio.
Yep. All right. Next slide, which is our last slide, the affordability index. Kind of like what you're talking about, Steve. A lot of great opportunities. And then just for if you're new to this, If you look at the affordability index, it's a measure of the typical mortgage payment versus the typical cost of a home. Obviously, look at the top two, LA, Irvine, 90 and 100, basically 99%. That's not sustainable. That's a market where everyone rents except for some wealthy folks for the most part. I look at Dallas. Dallas. Dallas is if they're 18th. They're 18th last year. They're 19th the year before. They're pretty consistent. Houston and Austin, they seem to kind of flip-flopped a couple times. Back in 19, Houston was more affordable. Now, I'm sorry. Yeah, Houston was more affordable. Then it was Austin for a little while. Now it's Houston. Houston's more affordable. The lower down on the chart, the more affordable you are. But I look at this and I look at the markets like in Arlington, Fort Worth, San Antonio, Garland. Like there's still some great opportunities in Texas to pick up some real estate really cheap. You know, those are markets where you can cash flow. When you're buying the average price in San Antonio 280. I mean, that's a pretty low number. And the income is still relatively close to Houston's. We always talk about it, but it's still amazing. If you look at Houston's income, $66,000 a year, San Antonio, $66,000 a year. But the real estate is almost $100,000 more expensive in Houston. So I know we keep talking about San Antonio as a great opportunity, but this tells me right here, there's room for those prices to go up, in my opinion. You still get amenities of a great big city as well. Anything else on this one?
I don't think so. I mean, this is just, it still shocks me when I see that 99% of your income goes to your house. No food, no travel, no romance, no nothing. You're just paying for a house.
Yeah. All right. Well, David, if you want to get to the next slide. Really, the only thing we have left to do is we have a drawing typically. David, have you done the drawing for the winner this month?
Yes, sir. And our winner is Vincent Yim.
Sorry, Vincent who?
Vincent Yim is our current winner for today's webinar.
Congratulations, Vincent. We will have one of our loan officers reach out to you. Steve, we have this up here. Anything you want to tell the people about Total Wealth one more time before we go? Our time is up. Any events you guys are having or anything you want to talk about?
Yeah, just briefly, we have free sample classes throughout the month. If you'd like to learn about Total Wealth Academy and how we're teaching our students to build wealth with real estate, just go to totalwealthacademy.com. There's a free sample class button there. We also have a spotlight night where we actually do case studies of current deals. There'll be a apartment case study, generally, 200 units, 300 units, and then a single family case study. But either of those are a good way to expose yourself to Total Wealth Academy.
Great. Well, Steve, thanks again for hopping on.
Always
a pleasure to have you on here. Looking forward to the next event at Total Wealth. And everybody else, y'all have a great one. Stay safe.